I generally don't like the word super cycle, but I do think we're in a commodity bull market. I don't really know how to define a bull market versus super cycle, so I just call them bull markets. But it's basically tied to the capex cycle. You have a period of rapid capital expenditure, new sources of energy, new deposits all coming online, and eventually you flood the market with too much. You have some sort of economic slowdown, which hurts demand. Then you kind of enter this long period of oversupply, cheap prices, lack of capex. And going forward, I think that's turning, and it's really been turning since kind of the pandemic bottoms. And so I do think that we're likely in a multi-year, ups and downs, but a longer-term commodity bull market.
Over the past few months, there have been lots of talks about an impending commodity supercycle. Several commodities analysts, like contrarian analyst David Hunter, have predicted that the next wave of quantitative easing by central banks will be quite huge, and it will be the final proof to investors that the fiat debt-based system is doomed to fail. In the United States, for instance, the national debt is on its way to $34 trillion, backed by a paltry $8.7 trillion Fed balance sheet. Experts are predicting that after the next wave of liquidity pumps, the Fed's balance sheet will swell to over $20 trillion, while the nation's debt will be around $50 trillion, dangerously close to a 200% debt to GDP ratio, according to estimates. This is why many financial experts believe a commodity supercycle is inevitable. As the dollar loses more value as a result of the constant debasement, more investors will rush toward tangible assets like precious metals and other commodities. These are tangible assets that have a better controlled supply pace, making them far more valuable than a so-called reserve currency getting devalued at a rate of 7% per year. Popular macro analyst Lynn Alden has joined the throng of analysts predicting a multi-year bull market for commodities like gold and energy. According to Alden, a popular sound money advocate, the global geopolitical and economic dynamics are rapidly changing. We are moving from a unipolar world to a more multipolar one, with several superpowers, and commodities will take center stage in that transition. We will now bring you clips from Alden's recent interview with Commodity Culture. Please watch, share, and like this video. Also, ensure you subscribe to the channel, turn on the notifications bell, and drop your comments and observations in the comments section below. Thanks, and enjoy the video.
I think a lot of countries are realizing that they don't want their sovereign savings to be freezable by another country. And so self-custodial assets are really the only way to do that. And gold is the densest way to store value in the physical realm. And so there's been if you look at a chart of BRICS and BRICS allies gold holdings over the past, couple decades, they've gradually risen and caught up with U.S. official gold reserves. At the same time as you've seen, kind of flat foreign treasury exposure over the past 10 years or so. There's just been not a lot of accumulation, especially compared to how much has been issued, how much treasury issues has come to market. So the foreign percentage ownings of treasury keeps going down. And I think it's because we're exiting the period of unipolar power. The U.S. is the hyperpower. Everybody just kind of putting all of their eggs in one basket of the U.S. I think we're seeing more kind of decentralization in that regard. And I think, Russia was kind of the bellwether for that. They had already largely de-dollarized around the market, with their reserves. But they got, I think, caught off guard by the euro area freezing their euro reserves. So basically, U.S. and allied, pools of capital are now less attractive, I think, to a number of BRICS type countries. And I think we're basically we're seeing more of that shift. And with gold, it's held up very well despite the sharp rise in real rates, in large part because I think there's a good amount of sovereign buying. And so I think in the years ahead, it's likely to have a decent breakout, among the younger investors, or even just increasingly some institutional investors that has to compete with Bitcoin now. So there's like a fracturing of what people were used was as hard money. So that's kind of a headwind against it. I think it would be higher today if say Bitcoin was never invented, if that technology was not ready yet. So now, but I think those two together are in the process of kind of taking market share back from the very centralized dollar system. So most commodities tend to move together. Not all of them, but in general, when you have a structural, commodity bull market, it's usually because the dollar is weakening, and it's because the commodities are going up in value. So a lot of these things tend to move together. So I just kind of by extension, I'm bullish on silver. It has a number of industrial applications. It still has some degree of monetary premium. Ever since the dawn of the telegraph, the silver's lost a big chunk of its monetary premium, and what I mean by that is the gold to silver range of trading was pretty much between 10 and 20 for like thousands of years. And ever since the dawn of the telegraph, where we relied less on silver's divisibility for money. So basically, for eons, gold was like the money for merchants and monarchs, and silver was money for the people. But when we start using banknotes and bank accounts and things like that, and we started abstracting gold, people kind of dropped silver, and so silver got left behind. And in its current environment, we see central banks are stacking gold, not silver. That's where big pools of capital go, because you get a lot more value dense, for what you're doing. And so I think that silver is likely to come along for the ride, and it has its own supply-demand characteristics. But I'm broadly bullish on most large commodities.
During the interview, Alden talks about the overall macro picture in the United States. According to the popular financial analyst, the national debt has become much too large to be supported by our gross domestic product or the dollar's reserve currency status. In addition, real rates have moved from negative to positive, which means as the debt increases, so will the interest expenses. Today, the interest on the national debt alone is closing on $680 billion and climbing rapidly. The Treasury Department is expected to issue more bonds worth trillions of dollars before Q2 2024. This means high debts and higher interest expenses. Lastly, tax revenues are dropping almost at the same rates as the nation's debt is climbing. This means wider budget deficits, which is already expected to hit $2 trillion in a matter of weeks. Alden believes all of these mounting issues will lead to a multi-year bull market for commodities. Let's get back to the interview.
I generally don't like the word super cycle, but I do think we're in a commodity bull market. I don't really know how to define a bull market versus super cycle, so I just call them bull markets. But it's basically tied to the capex cycle. You have a period of rapid capital expenditure, new sources of energy, new deposits all coming online, and eventually you flood the market with too much. You have some sort of economic slowdown, which hurts demand. Then you kind of enter this long period of oversupply, cheap prices, lack of capex. And going forward, I think that's turning, and it's really been turning since kind of the pandemic bottoms. And so I do think that we're likely in a multi-year, ups and downs, but a longer-term commodity bull market until the prices go up enough that enough new capex comes online and starts the next cycle. So yes, I'm broadly bullish on commodities with different time frames, generally long-term, especially centered around energy. So on one hand, it's a return to normalcy. So instead of negative real rates, we're back up to a period of positive real rates based on many factors. What makes it challenging, though, is that we're back at positive real rates with much higher debt to GDP ratios and very large deficits in the United States. And that's obviously a challenge. So we've had, over the past 30 plus years, there's been a very strong disinflationary trend, globalization, China opening up to the world, followed the Soviet Union, Russia opening to the world. So Western capital, Eastern labor, gas from Russia, all this got kind of interconnected, very disinflationary. That allowed interest rates to keep coming down. But now, and that offset the constant debt to GDP appreciation. So if you double your debt but cut your interest rate in half, your interest expense is still manageable. But what we're seeing now is that things bounced off zero. Now that there's been more fiscal, there's been more inflation. There's less kind of the rate of globalization at the very least is slowed down, and in some areas it's outright reversed. And so now we have higher interest expense on a very, very high debt load. And so for the first time in a very long time, fiscal deficits matter. It affected, basically the UK last year. It resulted in a change of government in many, by the bond market. And now in the United States, we're seeing that just very large amounts of treasuries coming to market. So there's like a supply problem and a repricing. And I think it has long-term consequences. But in some aspects, it's a return to normalcy.
Meanwhile, the U.S. economy may be showing the first signs of deceleration, according to the Labor Department's latest non-farm payrolls data. According to the reports, non-farm payrolls increased by 150,000 in October, against the Dow Jones consensus forecast for a rise of 170,000. Unemployment rate rose to 3.9%, the highest level since January 2022, almost 2 years ago. That was also before the Federal Reserve started its unprecedented rate hikes. Many analysts have warned that the first signs of trouble will be a jump in unemployment. Do you think we have arrived at that point? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on the notifications for more videos. Thanks for watching.